So Ghana has reached a staff-level agreement with the International Monetary Fund on a fourth review of its $3 billion extended credit facility, potentially unlocking a fresh disbursement of about $370 million pending board approval. Now, this development follows a turbulent economic period marked by policy slippages and underperformance, which the newly elected administration of President John Dramani Mahama has sought to correct through renewed fiscal and monetary discipline. Now, the agreement signals a cautious endorsement of Ghana's course correction, though challenges still persist. I mean, challenges around stabilization, around inflation, managing the debt, restoring investor confidence, and all that. So this morning, we're joined by Patrick Abankwa, a financial analyst and investment advisor. Patrick, thank you so much for joining us.
Thank you very much for having me this morning.
Okay, so let's quickly look at this. What were the key factors that led to Ghana's poor performance under the IMF program at the end of 2024, and what does this suggest about the program's initial design?
Thank you very much. I think that what caused the challenges that IMF has reported this week has to do with about three factors. The first one had to do with revenue shortfalls. There were a bit of revenue shortfalls in terms of tax collections that underperformed in the latter part of last year due to weak compliance and delays in implementing some key revenue reforms like VAT streamlining, property tax enforcement. So that's one part, revenue shortfall. The second one was expenditure overruns. We all know that when it gets to election in Ghana, usually the government of the day gets into some kind of deficit when it comes to financial mismanagement and all of that. So there was a bit of expenditure overruns, which stems from rising public wage bills and some energy sector subsidies that were not managed and offsetted well within the period. Then there's also the debt sustainability pressures within the last 3 months of 2024, which meant that high debt service costs, over 50% of revenue pre-restructuring, crowded out some critical social and capital spending that were done within the period. So these were the critical factors that led to government not being able to perform very well in the latter part of last year, 2024.
Now, could the IMF's approval of $370 million disbursement signal some sort of leniency towards Ghana's policy slippages? And probably that might also potentially undermine fiscal discipline in the country.
No, I wouldn't say that it's led to the relaxation. The disbursement, of course, led to some covering up of 15% of the 2025 external debt service requirement. There was also the need to boost our reserves. So before the debt restructuring, our reserves were quite low, but with the disbursement, it led to the reserves for the country standing around 3.1 months of import cover. Then it also signaled some confidence for our lenders, especially the World Bank budget support lenders, the critical lenders when it comes to the bonds that the country was battling with. So for me, it doesn't mean or did not signal that we had relaxed in terms of our expectations, but there were critical things that needed to be done with the disbursement that I think we are on course in meeting those critical factors.
Now, does the Mahama administration's swift policy corrections indicate some sort of genuine concern around its reforms to bring the IMF program back on track? Or you would just consider it maybe a pragmatic approach just to secure the funds?
I think that the new government has taken some corrective fiscal and monetary steps. And I think that its implementation can be seen in various ways. First of all, we are looking at the fiscal adjustment. If you look at the budget that was read by the minister, there was an introduction of the 22.5 VAT rate adjustment and a stricter enforcement to e-invoicing, which usually leads to curbing down on evasion of taxes. Then there's also the expenditure rationalization, which means that government is now going to look at how to cut non-essential capital spending and also freeze on some new highs in non-critical sectors. And this, again, is going to put the economy back in shape in terms of the expenditure that over the years has been running down the drain because we push a lot of expenditure into non-critical sectors. There's also the BOG or Bank of Ghana monetary tightening policy. So Bank of Ghana recently increased the basis point for the monetary policy, which is expected to anchor inflation expectations and help stabilize the cedi or the currency Then there's also the structural reforms, which here we are referring to the accelerated energy sector audit that is ongoing and timelines to eliminate about 1.2 billion in arrears to the IPPs. And IPPs over the years have been a very difficult aspect for our energy sector because of the debt that we owe to them. So if you're able to streamline and do proper audit, then once you're able to eliminate that, it gives government some kind of space to be able to engage in other projects. Then there's also the political economy challenges where we should be mindful of resistance to some of these policies that government is bringing on board, which may lead to some delay in its full compliance.
So looking at the policies of government, it could be a little bit of this and a little bit of that when it comes to what can be achieved and what can be missed. But then in terms of what is being missed, now Ghana's primary budget posted a deficit of about 3.25% of GDP according to the IMF against a target of a surplus of 0.5% of GDP. Now, I'd like to find out what are the risks and implications of this missed target.
So the missed target poses about three main risks. The first risk is the obvious one, which is the debt sustainability. We all know that higher borrowing needs may revive market concerns. Already, they have gone through restructuring. Investors are expecting government to be able to pay them now with the extended duration of payment when it comes to the investment. Now, this missing of target begins to create some concerns for these investors, and that can lead to raising the yields on Ghana's Eurobond post-restructuring. So that's the first risk. The second risk is the IMF program's credibility itself. Repeated fiscal slippages, for me, could trigger a deeper conditionality or delayed disbursement in subsequent tranches that we are expecting as a country. Then the last one for me will be the growth trade-offs. And here we are looking at austerity measures that we must be taken to correct this deficit, which sometimes leads to further spending cuts, and that may dampen the economic recovery of Ghana. So I think that the immediate priority for government should be to re-establish credible revenue mobilization to avoid these compounding arrears.
Credible revenue mobilization, like what?
So, as I said, tightening up the revenue collection process.
Okay.
As much as possible, let's try and put in place e-collection. So, e-collection here means that people must file their taxes through a system that is digitized. Once it goes through human beings, that is where the corruption and cutbacks come in. Once you do this, you're able to streamline it, and then also expanding the tax base. We still have predominantly only a few people, about 30% of Ghanaians, I'm told, pay tax, direct tax. It means that about 70% of Ghanaians do not pay tax in terms of tax that is attributed to their revenue. And that is where government, together with various groups for the informal sector, must put in place strategies to rope in these people. That will put less pressure on those that are paying. Otherwise, every now and then we keep on putting extra pressure on the little 30% to carry the 70% along. And that, for me, will lead to people evading tax, and that can lead to us missing the revenue target that we are seeing at the moment.
Okay, so with these postulations and this economic advice that you were given and tying that to the new budget, which targets about 1.5% primary surplus, do you think that can help grow or improve the macroeconomic indices of the country?
Yeah, I think it has the potential to increase the indices that we are referring to. So one, we are talking revenue assumptions. The budget projects about 20% increase in tax receipts. And for me, it's very ambitious if you look at the broadening tax base. So as I said earlier on, we need to be able to tax the informal sector. If this 20% increase is geared towards the informal sector, then the target that we have set for ourselves is something that we can actually achieve. Then the second part of the discussion is that beyond the revenue that we are trying to adjust is expenditure discipline. How we can stay within our own budget lines. Contingency liabilities like energy sector bailout could derail target that we set for ourselves if we don't cap it. So I think that government must begin to cap some of this expenditure and ensure that we don't go overboard. I think my baseline view would be that between 1% to 1.2% surplus is a more realistic approach, given our implementation lags over the years and also some potential shocks that we should expect, especially if you look at price relating to oil volatility. But the 1.5 for me may not be one that we can achieve. But 1% to 1.2 is something that we can really push for this year, the first year, which is the 2025, and then hope that in 2026, we'll be able to get to the 1.5 primary surplus target and even beyond that.
And probably that would mean, taking these policies in gradual strides so that we don't have a clogging of the implementation. Of course, we hope that that can actually translate into some sort of economic gains for Ghana. Patrick Abankwa, financial analyst and investment advisor, thank you so much for sharing your thoughts with us.
Thank you very much. Thank you very much.
Of course.